Hey guys, hope everyone's going great guns today. Alrighty. Hope everyone's good. Feel free to say hi if you're here. With this beautiful weather we had today, I think in New South Wales is coming to an end for a couple of days, but it was good to see a bit of sun after that terrible weather we had last week. No, not this weekend, gone the weekend before, but guys, unfortunately Australia does that. And unfortunately people lose their assets through that. That's hopefully all the insurances pay out. So guys, apologies I didn't come on last week. I just didn't feel it was the right time to do that. But tonight I'm going to be giving you a good overview of depreciation. Now, depreciation for me is a massive part of a property portfolio. I'm huge in using the depreciation to offset not just tax, but offset income as well. So, and potentially you can offset capital gains tax with depreciation too. Depends on how your accountant processes it. But guys, I'm really keen to show you depreciation. Depreciation is a big part of my personal portfolio, most of my clients' portfolios, and there's reasonings behind all of that. But tonight, I just want to break down for you different parts of depreciation and why they're relevant to the property investment market. So, guys, before further ado, let's get cracking on it. But sorry, like always, if you have any questions, pop them into comments. I love questions, or you can pop them in the group after if you're watching this on a replay. And for those of you who have friends who are not on Facebook, normally the next day we upload this to our YouTube channel as well. So feel free to, if anyone wants a bit of wording on property investment, feel free to pop them over to the YouTube channel under the property bloke. All right. Thanks again, guys. So let's get started. I'm just going to share my screen again, guys. I do prefer a PowerPoint presentation to show you that it's all written out for you straight away. Just got to make sure she all pops up. Great. Okay. All right. So depreciation. And my comments here is, are you missing out on cash flow? So if you have a large property investment portfolio and you don't have any depreciation whatsoever, there's a high chance you're either A, missing out on cash flow, or B, getting hit with a huge tax bill on the income that is bringing forward to you. So depreciation is something that a cash management fund in a bank can't give you, and also a share fund can't give you either. So the property market is where you find a lot of the depreciation. But also, of course, if you're self-employed or potentially have a car allowance, whether you're working in some sort of on-the-road job and you have your own car, depreciation is a big factor there too. But I'm only going to relate this to property because, as everyone knows, I'm not an accountant. So everything we're talking about tonight is just general in nature. And a lot of the information I've actually have tonight is from a company I regularly use to calculate all our depreciation for our clients. All right, let's get started. Hey, Steve, how are you, mate? He's been waiting. Very good. I hope I can make it happen for you there, Steve. All right, so tax depreciation. So what is depreciation? Tax depreciation is a tax deduction claim for natural wear and tear of an income producing building. This is obviously just related to property and its assets over time. It is generally the second biggest tax deduction for property investors after interest. And honestly, in some cases, is actually depreciation is higher than interest and can make a big difference to your overall property portfolio. All right. Okay, so as you can see here, I'm going to just share with you guys who I personally use for all our clients and also for myself. The company's called BMT Associates. I've been dealing with these guys for over 20 years. I actually started dealing with these guys when they only had a Newcastle office. Now they're all over Australia because they're very professional in what they do. A depreciation schedule, or what they call a quantity surveyor's report, that costs, it's only a one-off fee. So if you buy a property, you can get that done. And it's a one-off fee, and that fee will range normally from $440 to $770, depending on your style of property and depending if they have to do a physical site inspection. Most of our clients get away with around the $500 mark, but that's because we put together everything as a package for BMT Associates, so they don't have to go on site. It's a great way of saving a couple of dollars. So basically what I wanted to share with you here is just BMT Associates details. So if you are out there buying property, give these guys a call, make sure you get a good depreciation schedule from these guys. But I'm a huge believer that the BMT are one of the best in the marketplace. They are one of the biggest now, and they have good systems in place to make it all work. All right. So BMT and Associates, when it comes to tax depreciation, they specialize in tax depreciation. Now, they're what they call a quantity surveyor. So as you can see here by this slide, a quantity surveyor is the one who organizes the depreciation schedule. And because they're a licensed quantity surveyor for tax, property tax depreciation, the Australian Tax Office recognises their report. So it's not like you get a report done by these guys, do your tax return, get an audit, then have to pay the taxman money back. It's all licensed, it's all protected for you. So everything you can claim for depreciation is tax deductible, and you won't have to have any issues with the ATO, which is, yeah, that's a huge thing. We don't want issues with those guys, definitely. So this is what a quantity surveyor is. They basically specialise, a quantity surveyor, just so you know, is not a land surveyor. A land surveyor is the one who measures your boundaries of your block of land. A lot of people get them mixed up. A quantity surveyor is someone who specialises in building measurement and estimates to value the construction cost. Now, some quantity surveyors actually will put a report together on the basis of how much an apartment building is going to cost to build for a bank. That happens as well. But for this one here, we're just using it for the mum and dad investor to get the best tax benefit possible from their property, because every property investor, especially in Australia, you need a tax strategy behind your property portfolio, whether it's to save on capital gains tax or whether it's to save on your own income tax. You need to have a good accountant to put a really good tax strategy behind your property portfolio. Tax plays a big part in Australia. We're one of the highest tax countries in the world, so we have to use the laws that are in our favour and take advantage of it. Alrighty. So best way to explain it, I'm going to break it all down bit by bit for you guys. So we've got construction costs. You've got my fancy picture here, a house it's probably a bit over the top for an investment property, but I did steal it from BMT and Associates because it was easy. So the construction cost of an approximate 4-bedroom house, and it does vary per state, sorry guys. So this is just an estimate. It's not exactly how much it will cost you. Different states cost different to build properties. But construction cost is $309,500 in this example, because what we do is we get a thing called a Phase A report done for a development if we're involved in new buildings. And that Phase A development, that Phase A report gives us an estimate of what depreciation is available in the property. So we look at that before we put a client into that property as well. So construction cost $309,500. Now there's two parts of depreciation, and everyone who has not invested in property before misses out on this. They don't quite understand depreciation. So the first one is what they call Division 43, which is capital works. The best way to explain that is it's just the raw construction cost. And the second part is Division 40. Now that's plant and equipment, which basically is fixtures and fittings in there as well. So you'll see that Division 43, they've allowed 275,000 plus, and Division 40, they've allowed 34,000 plus there as well. All right, that's our sort of scenario I'm working off tonight. I'm actually going to break it down for you later, guys, as well on old versus new and how the actual cash flow comes into place. I thought that would be good for everyone to see as well. Alrighty. So Division 43, capital works. This is a pretty simple one. It's raw construction. So when we talk about raw construction, I'm talking about concrete, plumbing, all the stuff that keeps the property up and going. I'm not talking about the fixtures and fittings, which is a big part of your kitchen with dishwasher. You've got air cons, fans, blinds, fly screens. That's all fixtures and fittings. It's not part of this depreciation. So depreciation is normally calculated on especially the fixtures and fittings on what the lifespan is of that item. So with a house here, they've basically got Division 43, which is capital works, 275,000. Now this depreciation can be written off at 2.5%, and that'll last you for 40 years. So that's a long time to have this depreciation in place. Now, what that means is you'll see there at 2.5%, $6,881 is what you're allowed to claim against your rental income or against any losses against your personal income with this allowance. So if you buy an older place, you won't have as much of this, and you probably won't have any fixtures and fittings at all. But just the raw construction cost, that's $6,800 you can get done straight away. That's every year for the next 40 years that you can claim against your property. And this one's I love this one. This is the fixtures and fittings. Now, guys, I couldn't make this slide. I couldn't zoom in any further because it is a quite detailed breakdown, but you'll see here, the best thing to do potentially is to look at this. If you can't see it on your phone, maybe watch it later on your computer at work. That's probably not a good idea doing personal stuff at work, but computer, laptop, iPad, you can probably break it down a little bit more. But you'll see here with the Division 40, the plant and equipment, this is the fixtures and fittings of a property. So with this here, they break down air conditioner, like a remote control garage door, blinds, carpet, dishwashers, even got their door closers, everything in relation to the property. They've isolated, given it a cost. And then what they do is they give it an effective life. So how old or how long they believe that this item will last for you to have to replace it. And then of course they give you a depreciation percentage, which gives you a year by year breakdown of what you can claim on this property, guys. This is a huge thing. There is another one called pooled, and that's for low valued pooled items. I'm not going to go into that. That just makes it more complicated, but you'll see with this report. So you'll get this report from BMT Associates. You just give this to your accountant, all done, finished. Some accountants will offer to put it together for you. Now, always say no, because a quantity surveyor is licensed at doing this job. And as I said, it costs a few $100s. This report will last you for 40 years. And anything you do to your property after you buy it, you can add to this report, which your accountant can do on a spreadsheet then. But with this initial report, please always get it professionally done. If you don't use BMT Associates, use a licensed quantity surveyor. Use anyone that's licensed, but get a really good report done, because this will hold up against the ATO in case they ever give you an audit. Because as you grow your portfolio, you actually get flagged easier of potentially being audited by the ATO. So you want to make sure you do everything right here. We don't want to get on the wrong side of those guys. And you will see down the bottom of this page, it actually covers the capital works at the bottom here, where you've got the 275,000 again. So guys, that's how they work it out. This is the report you get when you use the Property Bloke. We send that off to the accountant on your behalf, so that when you do your tax return, they've already got this depreciation schedule in place. This is a huge one. You can break it all down. It's amazing. So you'll see here, actually in the first year, this is the 1st of July to 30th of June scenario, the $6,871. So between both of these depreciations, so when you add the capital works and the fixtures and fittings, which is Division 43 and Division 40, you actually have over $13,500 worth of paper deductions. A lot of people don't realize depreciation is what they call a paper deduction. It's not a cash deduction. So a cash deduction is when you've outlaid $13,000 for repairs and you're getting the tax benefit back for that. But this is on paper. So this is, you're not outlaying the money. It's just part of the process, which is fantastic. Okay, so you have to know though, there was legislation change back in 2017, which when you do talk about, so this doesn't affect Division 43, which was the capital works, which was that raw construction. This only affects fixtures and fittings. So if you buy a property, basically what they're saying, if you've bought a property after the 9th of May, 2017, so if you were before that, it doesn't matter. It has the grandfather clause, so it'll just keep going. There's no effects for you if you bought a property prior to this. But if you bought a property after this, you do have issues if you bought secondhand. And what I mean by that is, when you see these pictures here, they break down what are plant and equipment assets. And you've got here dishwashers, air cons, curtains, smoke alarms, all this sort of stuff. And what that basically says is, if you purchased a property after that 9th of May 2017, you're limited to what you can claim on depreciation if the property was secondhand. But if the property was brand new, you paid for everything, and that is fantastic. And this is why we really promote buying brand new for many clients' portfolios when they need this depreciation as a deduction. If you don't need depreciation, fine, buy whatever you want. But if you're on a higher taxable income, depreciation can be a big player in your portfolio. And when I say high taxable income, I'm talking from $80,000 onwards, if not a bit lower. It can still work it still works fantastically well for you, especially when you're offsetting positive cash flow. That's what people don't realize, but I'll get to that in a minute. So basically what it says is if you buy a property here, Division 40, I think I get confused sometimes, sorry, Division 40 deductions here. Basically you're in a situation that if you bought it secondhand, you can't claim all this. It's a lot more restrictive. You can't, because you never physically paid for that item to go into the property, especially if it was an investment property prior to you buying it. What the ATO have changed the rules is because people were claiming it, the first person was claiming it and the second purchaser was also claiming it as well a few years later. So to stop that, if you bought a second-hand property, the ATO was saying you can't claim most of those plant and equipment assets. I think there is some that you can claim, but it's not much, guys. It's not much. And not just that, you're buying a second-hand home when some of this stuff may have to be replaced as well. So it affects you if two things that you get affected. One is if you're buying a second-hand property that has been an investment property or owner-occupier before. And the second one is, and this happens a lot where people think, it's okay, I've got my home now, let's move out of this place, buy a bigger house and rent out our current home. It affects that as well, guys. So it's not as, depreciation's not good on that either, because you're realistically changing it from an owner-occupied home to an investment property, but it's still secondhand. So by having that older property, you are not going to get the benefits you need to make sure you run your portfolio at a really good cash flow on a month-to-month basis. So who's affected? It sort of goes down here: owner of second-hand residential properties, etc. after the 9th of May. So some key points here are basically exactly what I've said so far. I think I've covered everything. Homeowners turning into their own home into investment property. Yeah, so the main thing is you have to know there that if you buy a second-hand home, you have to know you cannot claim anywhere near the amount of depreciation on fish and fittings as what you can a new one. And that doesn't take into consideration things like buying a cheap old house, which some people do. They think, I'm just going to buy a cheap old property because they think that's going to be cheaper to hold, but it's actually not. And a newer property, it could be $100,000 more, is still going to be cheaper to hold throughout the 12 months than what an older property is, because even with the depreciation benefits you're in front, but you've got to understand the quality of tenant could be lower. Property maintenance can be a lot higher. And if anything, you could go through very severe property maintenance with an older property. What I've done here is I've gone to the extremes of a very old property and a very new property, right? But I've done this for a reason. I want to show you the difference with the cash flow of each one. Obviously, some people will buy that old property, think they can renovate it, add a bit of value to it, and then hold that for time. But guys, you're going to spend a lot of money and you're going to have ongoing maintenance issues. So to make it fair, apples to apples here, I've done a scenario on old versus new, a purchase price of $500,000, a loan amount at $500,000 at 5%, and a rental income of $450 per week. So they're both the same property. One's old, one's new, but they were the same price, same rent, and same loan amount. Obviously, they wouldn't be in the same street because, you know, oh, that could be if there's a bigger block of land, but let's not get into that one. All right, so let's go through this. Your old property. So your old property here has a rental income of $23,400, but then you're going to take your expenses. So everything, it's like a business. An investment property is 100% like a business. Everything it cost you to earn that $23,400 in rental income is now a tax deduction against that rental income. Anything over and above that rental income that you have as a deduction can be written off against your personal income if you've got this property purchased in a personal name. Obviously, if it's in a company name or a trust name, it's not the same, but this is, I'm only really working off it being purchased in your own personal name. So with that said, we've got interest here of $25,000, property fees of $5,000. Now, what the property fees are, that's your land rates, that's your insurance, that's your property management fees. That could be lawn mowing, it could be strata, body corporate, it could be anything like that. So when you look at that, you've got an on-paper loss of $6,600. Now, and I'm working on the fact that the tax rate, I've gone in the middle. So the average tax rate in Australia is around the 40% mark. But of course, if you're on a 48.5% tax benefit, it's going to be better for you. If you're on a 30% tax benefit, it's not going to be as good. So on a paper loss, $6,600, you'd expect to get approximately $2,640 back from the tax man at the end of the year for this property running at a loss of $6,600. So your cost per annum is actually in negative of $3,960. So it was $6,600. Take off your $2,640, and you've got $3,960 is what this property is going to cost you. And I have got in brackets there, guys. A lot of people forget about this. This is not including property maintenance. You'll be surprised how many people don't take that into consideration. So we've done that. Let's get on to the new property now. So when you compare apples to apples here, so the new property, we're still saying it's getting the same rent, same interest figure, same property fees. The on paper loss initially is $6,600. But when you add that depreciation to that brand new property of $13,750 odd, your on paper loss is over 20 grand. So 40% of that is $8,143. So when you take into consideration, you had this figure here, 6,006. Oh, too far. Pressed the wrong button. Sorry, guys. Got to go back somehow. Previous. Sorry about that, guys. Okay, so your on paper loss was 6,600, but now you're actually in a position with all that depreciation, brand new property, really low maintenance or no maintenance, you're in a position where your actually tax rebate is covering all your paper loss. And on top of that, you're actually in front by over $1,000 a year. So realistically, at the end of the financial year, a dollar for dollar scenario, this property's cost you nothing. Do you know what I mean? With that secondhand property's cost you $4 grand, and that the liabilities in that secondhand property are quite high. But this depreciation benefits make a big difference to new property. Now, the benefit with this is that you can hold this example property, for example, on a $0 figure for as long as the rate stayed, the interest rate stayed 5%. And currently you can get like investment rates in the low 3%. So what I've done here is totally conservative. It's very, very conservative. So if it was at 3%, you're able to be, your in-hand benefit could be up around the $5 grand mark. So it's a positive cash flow property, but you have to be realistic. 3% interest rates for investment are not going to be here forever. Your property portfolio, obviously, you're going to have it for a long term. So you've got to think about the long-term effects. Unfortunately, a lot of people are thinking short-term at the moment. That's okay. That's their problem. All right. So that's old property versus new property. Does anyone have any questions on that? Feel free to contact us direct about that down the track with our 15-minute call. But the benefit of the new property is not just the depreciation, it's the peace of mind. We're huge in making sure you set your portfolio up as a set and forget portfolio. And realistically, the best way to do that, in my eyes, is new property. That is a personal opinion, by the way, not financial advice. All right. So another way, so what I showed you there before, sorry, I'll just go back a bit. What I showed you here before, this property on the right and the left, I guess, is what they would call a negative geared property. So a negative geared basically means it's running at a loss to get you that tax benefit. But I want to show you what a lot of my clients are doing at the moment, and what I'm doing personally is positive cash flow tax-free income. So you may have, if you recently joined us, you wouldn't know, but this property in this picture here is what we call a dual income property or a dual key property, where you may have a 3-bedroom one side, a 2-bedroom the other, and you've got a much higher rental income. So with these figures, what I'm working off is still the purchase price of $500, for example, but a return on investment of about $800 a week. So that's got a huge rental income of around $41,600. So when we look at that from an investor's perspective, again, what you're seeing is, in this scenario, great, you got 41 grand in income, but once you take your interest and your property fees off, you're actually, on paper, you've got an income of $11,600. Now that's fantastic, right? Positive geared, 11,600, give me 100 of them tomorrow. But if you don't have depreciation, you're going to pay tax on that rental income. So what I'm trying to show you here is that if you bought this under a new format, like a brand new property, that 11,600, you won't pay that 4,640 tax I've got noted there. The depreciation, once again, is 13,000 again. And on paper, you're running at a 2 grand loss. So this is on paper loss, not physical cash loss. This is just an on paper loss. So that negative $2,000 can be written off against your taxable income, and you can actually get a little bit more tax from that as well, but I'm not going to go into that. I just wanted to show you here, your on paper income of $11,600 with the depreciation offsets any tax liability on that rental income. So realistically, you've got tax-free income of $11,600. Now, a lot of people say to me, Wayne, why isn't everyone doing this? And I ask that question myself almost every day. It's a simple structure. It's not a hard property. You've got to, I wouldn't say they're easy properties to find, but we have our network of developers we deal with to get these properties. But why wouldn't you do it? That comes down to it. These properties have 2 tenants, and they should be a part of your portfolio. I don't believe, having this for your whole portfolio, depending on your strategy, but you've got tax-free income up here of $11,600. Sure, you're not going to get a heap of tax back at the end of the year, but you've got $11,600 worth of income, which to me is just as good. So it's not all about tax benefit, but it's all about having the tax strategy to avoid paying tax, avoid legally not paying tax. That's the biggest thing where people don't get. They think it's a bit of a shonky scenario, but it's actually a fantastic setup. And if you have a good accountant, they should be giving you some advice on this. A good accountant will always give you a bit of a nudge and showing you some direction on what you could possibly do and just showing you some scenarios. You don't want just a number punching accountant. You want a good accountant, a good property accountant. If you ever need one, feel free to reach out to us at the Property Bloke. We can recommend a few people, because the biggest thing for us is ensuring that you don't pay tax you shouldn't have to pay for. I'm always a big believer in you need to pay tax to be able to have a lifestyle, to be able to borrow money, but do not pay tax that you are not liable for. I'm a huge believer in that. All right, guys. So I'm going to get Jess to throw in the 15-minute link if she's still watching the live. But on that 15-minute call, guys, I can I just quickly go through a bit of your scenario, what you're trying to do, and then I can give you a bit of an outcome on some direction, I suppose, and I'll just point you in the right direction. You might just have a quick question about your own portfolio, a question about depreciation, whatever it might be. If I don't have the answer like on paper, I can send you to one of our videos that I've done that can explain it in more detail, whatever you need. So feel free there. We've got, Jess has popped it in there, 15-minute call where we can reach out and do that. Now, guys, there's Easter coming up. So Easter, don't eat too much chocolate. Good time of the year for the kids. Everyone's going on school holidays, all the parents, some like it, some don't, I guess, affects their work. But everyone enjoy Easter, enjoy the Easter break. Hopefully we get some beautiful weather over Easter to enjoy with whatever you want to do with your family. You just want to make sure you get that family time. It's one of the good times of the year where you can have 4 days off without getting in the trouble of your boss. But it's a great way of extending a long weekend. Try and get a sickie after. Nah, just joking. Guys, thanks again for watching. I'm really excited to talk about depreciation. I'm a huge believer in it. It has to be part of your portfolio. I'm Wayne Jessup, giving you real properties, real strategies to get your real results. And yeah, if you have any questions, feel free to reach out anytime. Thanks, guys. Speak to you soon.